Hi, Steve Van Metre here, and welcome to your Monday night premiere, where we take about 15 minutes every Monday and Wednesday night trying to make sense of markets that sort of are making sense. I mean, sort of, but we'll take a look at that. Now, today's big deal was the not the crop progress report. It's actually, let me just look over the crop production report from the USDA. Now, the USDA releases this report once every June every year. And there was so much flack over last month's report, they decided to redo it. Or not last month's report, but they decided to redo this month's report, or this year's report, because nobody believed it. I don't think people are going to believe this one either. But let's take a look. The content of this video is provided as educational information, is not intended to provide investment or other advice. This material is not to be construed as recommendation or solicitation by to sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that one do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Now, Ag Commodities got hit early. There's a fire in a cattle processing plant that's it's expected to have it shut down. So cattle prices fell, and then corn prices just went straight down in early trading after this report. So let me show you what the report had to say. And again, this is one of those things where farmers will weigh in on this probably over the next week, but there'll be a lot coming in the next few days. I don't think a lot of people are going to believe it, because what they're saying is corn production is only dropping 4%. And I've seen a ton of videos of farmland just completely wiped out. And I've seen corn farmers show how poor their corn crop is. But the USDA says we're going to get a near banner year of corn. They said soybean production is down 19%. I'm surprised it's not down more. Cotton production is up 23%, and winter wheat production is up 3%. So here you have a situation where the market's confused because the USDA is saying things are great. And on the ground, people are saying, I don't get it. So what's the truth? Well, that always happens come harvest time. And we'll look at the charts today. There was a lot of down. There will be a rebound at some point. We'll probably just have to take an exit at that level, just because apparently everyone is going to just short these commodities until it does break out, and we can kind of look to come back to that later on. But we'll let it rebound. There's nothing goes down perpetually. Everything does have a rebound, and harvest season's coming soon. So I guess we'll find out the truth at that point. Plus, bonds are getting really close to breaking out, and well, you got a sure bet. You got to take it. So let's go and back to the browser here, and let's just kind of look over some of the stuff we normally do on Monday, and then we'll hit the charts. Oh, and I got something on gold I want to show you too, but we've got that. Now, the NASDAQ McClellan Summation Index, or NASI, is down to minus 200 as of Friday. So this is updated obviously somewhere at night, and it's not updated yet. And this is telling us the liquidity is tight, which is evident in the stock market today. We'll look at that momentarily. Let's take a look at how hedge funds are positioned, and then I'm going to show you something interesting about gold that will kind of support my view. Now, one thing I was pretty excited about was looking at this report, because this is as of last week, and it's showing that hedge funds are still net short U.S. Treasury bonds. And this is fantastic news, because it tells us that they are still betting on higher interest rates as interest rates are falling, meaning they're losing money. I mean, you can look, the interest rates are down here. They weren't, they're in a loss position. They were shorting up here. So they're taking a hit. They're losing money. I mean, you could look in here and see where they were short. They started building their shorts up. Remember, they backed off and then they built them back up, but they built them up all in here. They're losing money, which means when they decide to buy bonds, and they will be forced into it, the short position will become long positions. Yields will fall. That tells us why yields are probably headed back to zero. I mean, this is just one reason. I'm just not counting all the other people that are going to buy bonds, but just looking at a position from the hedge funds. Same with 30 years. Rather than go long, they took even more short interest last week. So this is really interesting. It'll be, I'm eager as this weekend. I'll be eager Saturday to see this report again, because if they're still net short, Man, it's called load up the truck. When they go long, yields are going to crumble. Taking a look at crude oil, WTI still very, very long. And we had a build in last week's inventory. It'll be interesting to see if we get a build this week. We probably will due to the global slowdown. And that at some point will cause these speculators to unwind their long positions and literally cause oil prices to crash. I mean, that is coming. S&P 500, as it went down, speculators went longer. They increased their longs. And let's do gold last because I've got something else I want to show you. And same with the NASDAQ. As NASDAQ went down, they took on more long positions. And the only place they seem to be in the right side of the trade is in the small caps, the Russell 2000. They're net short, and small caps did fall last week. The dollar positioning is fairly stable. Dollar's rising, in a slowly rising channel. Some people believe there will be a blow-off move in the dollar. We'll see. Currencies are hard to play. You can make money quickly, and as fast as you make it, you can lose it. And taking a look at volatility, hard to see, but they backed up their short positions a little bit and took off some of them. And as volatility was rising, I thought today volatility would come back down. It didn't, but the week's not quite over yet. So let's go back to gold. And you can't see under this red line, but they're long way up here. You'll see momentarily. I got another slide for you. In fact, I should go pull it up while I'm doing this. There we go. And so they're taking a lot of long positions, and gold is kind of peaking out here. And I said that will happen. But remember, when you get a lot of longs, you get shorts with that. So let's go and look at how they are actually positioned. So this is the commitment to traders report. Someone posted this. Which is really cool. So this is a Tuesday last week. Everything's as of Tuesday of last week. But let's take a look at this. Large speculators. These are effectively hedge funds because of their size. They're holding 400,000 long contracts, which is the second largest long position in the history of gold. So they have only been longer gold one other time in history, and that was in 2016. What happened in 2016? Well, they were long up here, and boom, gold came crashing down and reversed nearly all of that upswing, which would tell us that it's coming down to this 1,200 level, kind of right where I think it ought to be. All right, now back to this. Hedge funds are short about 56,000 contracts. When you see spreading, this is contracts, people that are both long and short. So they hold a long and a short contract. But look at the commercials. These are the producers. This is the smart money, the second highest net short position in history. Now, why does this matter? It matters a lot because when gold stops going up or something causes it to fall, who is going to want to lock in their gains? These people right here. So as they sell or enter short positions, against a near record short positioning, bam, you get a big drop in price. And that's why this report matters. This is why we look at it every week, because it tells us this isn't the big breakout when you've got all this positioning short by the commercials. Now, what should happen is gold prices should come back down, and let's go and find them. And my bet is that those hedge funds will start loading up on everyone selling. So here you have second largest long on the hedge fund side, second largest short position on the commercial side or the smart money. Tells us it ought to back down way down into here somewhere. Again, 12 to 1250, kind of what I thought, because there's so much positioning, and it'll come back down pretty quick. And we can zoom out. Where's 2016? Here. You can see it got up here. So was down in the 1,050. Boom. Everyone thought big breakout up to almost 1,400 or 1,375. And look how far it retraced. Huge amount. It tells us right in here somewhere is where this is going. That is your signal that we are in a bull market, because at that point, the smart money has really bought up all the inventory. And then you get your bullish breakout. That's kind of what you're looking for. Okay, let's go and take a look. How much time do we have? All right, about 5 minutes. Perfect. S&P 500 is now let's see, where's this line at? A whopping 10 points higher than it was in January of 2018. This is despite $1.5 trillion of corporate share buybacks and dividend payouts, which tells you that if it wasn't for the corporate share buybacks, the stock market would be considerably lower. And despite $1.5 trillion, it isn't any higher. It's almost, not even 1% higher than it was back in January 2018. Despite all this noise, despite all the talk of a bull market, this is not a bull market, especially when that amount of money is flooding in. Not at all. All right, let's take a look at the VIX. Because remember, I thought we could see a move down here. There's just all this, bearish on the VIX pushing down. So I thought we'd get a reclaim over here. There are some times when it bounces off its 200-day moving average here, makes a little move up, and then comes back down and reclaims it and takes off. I still wouldn't be surprised if we see that. We should see the 50 and 100-day moving averages roll up. Again, we're close to the breakout, but September is going to be the month that probably happens. Looking at the VIX ETF, again, it came down, found some support right here, bounced off of this, but it's going to head right back into some strong resistance here where sellers were at. So the question is, are these sellers still sellers, or are they going to hold and get flushed out? Don't know. Let's take a look at the bond market. 10-year Treasury yields are fighting lower. They're getting very close to this breakout level. Probably ought to move one of these lines. Down here, you can see there's a lot of resistance coming back here from 2016. So resistance is where support going back 2016, because what was once resistance, overhead resistance, where it bounced off the purple line, is now support. So my guess is we're going to see some sideways action here. Let's look at the 30-year Treasury yields, which are pretty much sitting right at their all-time lows. And remember, a lot of people said, Steve, you're wrong about bonds. They're going to record lows. Interest rates are going to record highs. And here we are right where it was back in August or July of 2016. This is where yields are sitting. When this breaks through, things are coming out in a big way. Stocks will crash and bond prices will go straight up. This is a big play that we're very, 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 very interested in. Let's take a look at that from the perspective of the TLT position we hold. I guess we'll move back out here. So you can see it's kind of bouncing right through around right where it was at its all-time high. I suspect it will pull back to this 138 level. You can see it's gotten up here in the past. Sellers come in, try to drive it down, use the money from shorting treasuries to buy stocks. This is how it works. I suspect there'll be a little sideways action because the 50-day moving average is curling up. This thing has followed a classic bull market rally. It's following the 50-day moving average up. The 100-day moving average is rising. So it kind of gives me the feel that there's one last push lower, whether it's down to fill this gap or whether it's just to go sideways. And by that point, we'll be real close to September when the Treasury starts borrowing. And unless the Fed comes out between now and the Treasury borrowing and says that they're going to subsidize all this government borrowing, and I don't think they're going to. I think they're going to have to cut, but I don't think they're going to cut a lot. I think they're going to, let this thing eat itself, and then they're going to come in. It'll be too late. This is where the opportunity is. It's in bonds, not anywhere else. All right, and that is why we want to pick up the zero coupons, because let's look at today. The 30-year bond moved up 2%. The 30-year zero coupon moved up a little over 3%. That's why we want to take the equity portion of the legacy models and put it here, probably on a pullback, because there's a much bigger play when this thing goes straight up. And as I pointed out, you can see going back to 2008, when you finally break, here's bond prices break to new all-time highs. They go vertical very quickly. Vertical. That's where you make all your money, right there. And somewhere at the top, let's see how much time you have. Here's 2008. You've got maybe a week in here. You get out, and make your money. And this move right here is somewhere around a 30% return in a month on bonds. Try to find that in the stock market. You cannot unless you get super lucky. Here's ag commodities. Big surprise. Bam. After a little bit of rally last week, big selling today across the board. You pretty much have now every bit of bad news you could want. China not buying anymore. The cattle processing plant down for maybe indefinitely. And ridiculous estimates of corn production, which I don't think are going to come true. But nevertheless, every bit of bad news is baked into this. And what happens is after long moves down, you'll get this spike and rally. You'll see, down move, rally, down move, rally, down move, rally, down move, rally. So we're due for a rally here. Maybe when it gets up into here somewhere, we'll look to exit it. Or if it can break through the 17 level, it'll get up to here, and maybe we look to get out. But there will be a move up. When it comes, I don't know, but it seems to be that the sector is just, everyone wants to short it. So, okay. Unless it breaks out, we'll look to exit and try to jump on the bond bandwagon, make some money while you can. Because if the TLT goes up around 30%, say when interest rates crash, the zero coupons do about 50% over the same period. Can't do that in stocks, and you can't do that in a month. I'm Steve Van Metre. I'll see you Wednesday. Bye now.